Hello students, welcome to Accounting Explained at Accountwise Academy. This is Latha Venkateshwaran. This is the third video on payback period. Today we are going to learn about post-payback profitability method. One of the limitations of the payback period method is that it ignores the post-payback returns of the project. It does not consider the profit earned after the payback. What is payback period? Payback period formula is original investment divided by cash inflow. This can be even cash inflows or uneven cash flow inflows. This we have covered fully in my previous videos. You can go through those videos for a better understanding. I will be sharing the link in the description box. So, to rectify the defect, that is to consider the post-payback returns, post-payback period method considers the amount of profits earned after the payback period. The other name for post-payback profitability method is surplus life over payback period method. Surplus is here the returns earned after the payback period. According to this method, payback profitability is calculated by annual cash inflows in each of the year after the payback period. So we are going to take the returns which we earn after the payback period. This can be expressed in percentage of investment. This can also be expressed in percentage. So first, post-payback profitability is equal to annual cash inflow into estimated life minus payback period. If the payback period is 4 years and the estimated life is 10 years, then 10 minus 4 into annual cash inflow we have to do. Okay, the above formula is used if there is even cash inflow. This formula is for even cash inflow. That is, for example, if you are going to earn 25,000 rupees annually every year for 10 years, that is called as even cash flow. In the case of uneven cash flow, the following formula is used. Post payback profitability is total annual cash flows, okay, minus initial investment. We are going to calculate all the cash inflows total. That is for 10 years, whatever we are earning the uneven cash flows. First year it may be 25,000, second year it may be 27,000, third year 30,000, fourth year again it may be 26,000, like that. Okay, we are going to total everything minus whatever the initial investment. We are going to deduct it to find out the post payback profitability in case of uneven cash inflows. Post payback profitability index. Post payback profitability is used if the cost of the projects are equal. Suppose you are going to select one of the two projects. The projects are A and B. If the cost of the projects are equal 10 lakhs, then you can go for post payback profitability method. If not so, if the cost of the project of A is 10 lakhs and B is 8 lakhs, then you cannot use post payback profitability. You have to use post payback profitability index only. The following formula is used to calculate post payback profitability index. Post payback profitability divided by initial investment into 100. First you find out post payback profitability. You divide by your initial investment and you multiply by 100, you get post payback profitability index. It is always expressed as a percentage. See here you are multiplying with 100, no? So it is always expressed as a percentage. While calculating the post payback period cash inflows, the salvage value is the scrap value which you get at the end of the life of the project or the asset by selling it, of the proposed project should be added. Besides, Cash inflows here refer to the cash inflow after tax but before depreciation at all times. First you have to add back the salvage value, the scrap value, and cash inflow here means cash inflow after tax and it should be before depreciation. Let us solve a question on post-payback profitability. From the following particulars, compute post-payback profitability and post-payback profitability index. Cash outflow is rupees 1 lakh. That is the initial investment. Okay. Annual cash inflow after tax but before depreciation is 25,000. So here they have even cash flow. Every year they have 25,000. Estimated life is 6 years. 25,000 for 6 years even cash flow they have got. First, to solve the question, we have to find out the payback period. Payback period formula is cash outlay or initial investment divided by annual cash inflow. So here what is initial investment? Initial investment is rupees 1 lakh. 1 lakh divided by 25,000, that is the cash inflow, is equal to 4 years as our payback period. First, let us find post-payback profitability. So post-payback profitability is cash inflow into estimated life minus payback period. What is cash inflow? Cash inflow is 25,000. Estimated life is 6 years. Payback period which we found only now, it is 4 years. So 25,000 into 2 is 50,000 rupees is the post-payback profitability. Now, post-payback profitability index is post-payback profitability divided by initial investment into 100. So, post-payback profitability is 50,000 which we found out. Divided by 1 lakh into 100 is 50%. We are going to solve another question where there is uneven cash inflows. From the following particulars, compute post-payback profitability and post-payback profitability index. Cash outflows 1 lakh. Annual cash inflow after tax but before depreciation is first 5 years rupees 20,000. Next 5 years it is 8,000 rupees. See, there is uneven cash flow. Estimated life is 10 years and salvage value is 16,000. The solution of the problem is as follows. First, we have to find out the cumulative cash inflows, then payback period, and then we have to go ahead with the post-payback profitability and then post-payback profitability index. Okay, so we have to open a tabular column which has 3 columns in it: year, cash inflows, and cumulative cash inflows. So year is still 10 years we have seen here. See, 10 years, estimated life is 10 years. So year has 10 years, 3, 5, 6, till 10 years we have got. And inflow is 20,000 for the first 5 years. So write 20,000, 20,000, 20,000, 20,000 for 5 years. And for the next 5 years it is 8,000. So write for 8,000 for the next 5 years. Next is cumulative cash inflow. First year it will be the same. Second year will be 20 plus 20 for the next year, 40,000. And third year 40 plus 20, 80,000, 60,000. Fourth year 60 plus 20, 80,000. Fifth year 80 plus 20, 1 lakh. Sixth 1 lakh plus 8,000. 1 lakh 8,000. Seventh 1 lakh plus 1 lakh 8,000 plus 8,000, it is 1 lakh 16,000. Eighth year it is 1 lakh 16,000 plus 8,000, lakh and 24,000. Ninth year it is 1 lakh 24,000 plus 8,000, 1 lakh 32,000. And the 10th year it is 1 lakh 32,000 plus 8,000, 1 lakh 40,000. Now we have to find out the payback period. Payback period is where it matches the year, where it matches the cumulative cash inflows, where it matches with the year. Here the cumulative cash inflow matches here in the 5th year. So payback period is equal to 5 years. Okay. Now we will go ahead with the post payback profitability. Post payback profitability is cash inflow into estimated life minus payback period. What is the cash inflow post payback period? We have to see. Okay, what is the cash inflow post payback period? It is 8,000. See, so 8,000 into 10 minus 5. That is 8,000 into 5. It is 40,000. Next, post payback profitability index is post payback profitability divided by initial investment into 100. So post payback profitability is 40,000, which we just found out. So 40,000 divided by initial investment is 1 lakh into 100 is 40%. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.